Monday, January 1st, 2024. Monaco 64, home of alternative economics and contrarian views. So happy New Year to all of you. Today, though, we're going to talk about whatever happened to higher for longer. And that's a term that was created by the central bankers recently about interest rates and how they're going to stay higher for longer. So we're going to look at that today. Before we do, though, let's look at some of the headlines because whatever happens this year, one thing's for sure, the Anglo-American Empire will be at war. They're going to pick someone to bomb or to whatever, to try to change regime. That's one thing we can be sure of until they collapse, of course, because I think we're close to a collapse of the Anglo-American Empire. And it's going to come through financially, I hope. So we've got here in the Telegraph, Shapps. And who's Shapps? Grant Shapps. Well, he's the Foreign Secretary, I think now. He's saying UK ready to attack Houthi rebels. We've got a tweet here from my friend Eric Jung. He says, wow, the first day of 2024. The headline reads, multiple reports that the US and UK are preparing to declare total war on the Houthis and Yemen. Apparently France might join as well. So the Houthis and Yemen, what's this conflict about? Well, I had a quick look over it, and it's basically a battle between the Sunnis and Shiites in Yemen. And the belligerents are Yemen, of course, the official government with the Saudis, who are Sunnis, with Jordan, Morocco, and the US has been behind that faction. And the belligerents, you have the Houthis, who are Shiites or Shia, and Iran, North Korea, and Libya until 2011 were supporting these rebels. So now it looks like the Anglo-American Empire wants to go full on into this conflict. What do I think it could do? I'm not sure. Maybe the US and the UK are saying to the Saudis, we'll help you here, and maybe you could soften your stance vis-a-vis the BRICS. And talking about BRICS, as of today, we should be BRICS 10, right? Yes, and I know Argentina didn't join BRICS. And yeah, that's fairly significant, but I don't think just one country will derail the BRICS enlargement and BRICS expansion, as they call it. So back to the main subject. Whatever happened to higher for longer? So yeah, the central bankers lately, in the last few years, they've been trying to they try to manage perception of investors, markets, consumers with brainwashing, basically, with phrases. And they think they can manage perception, that inflation is based on perception and psychology. They don't realize that inflation is what they cause by printing money out of thin air, like trillions in QE. Yes, the psychology might affect consumers, but deep down, inflation is the creation of currency and credit out of thin air. And they started a few years ago saying that the rise in prices that we started seeing in 2021 and even before the war in the Ukraine kicked off was transitory, that by 2023 or end of 2022, prices were going to come down to below 2%, which is a silly target that they have to debase your currency every year by 2%, to steal 2% from you without you really knowing it. And of course, they use a measure of prices to associate it with inflation. And we know, and you should know from watching my channels for how long now, over 8 years, that inflation is not the CPI. The CPI is a basket of prices that usually rise as a consequence of too much money and credit being created and the real economy not keeping up with that. So it's natural that prices rise. So they were completely wrong on this transitory story. And I think, they've been wrong again on this higher for longer. We even had the chief economist of the Bank of England, a guy called Hugh Pill, said that we're going to have the tabletop mountain policy. And most of you know the tabletop mountain in Cape Town. It's very flat and very long. But now we're seeing, from publications like the FT, who 20 years ago said that going gold, that the pointlessness of holding bullion continues to sink in, right? Those are the kind of people, and I'm glad I didn't listen to the FT when I read this 20 years ago. Well, just under 20 years ago. It was in April 2004. Because at the time, the price of gold was $400.65 on that day. I wrote it down, as you can see here. And of course, that price has gone up five times since then in dollars. It's gone up over 6 times in pounds. So you have to be very careful when you read things in the mainstream media, especially about gold, because they have an agenda to keep you away from it. Gold is only for the top people, according to them, and we, the plebs, have to hold on to their fiat currency. We have to let them extract wealth from us every year through inflation. So I saw this article yesterday in the FT, and it's by someone called Sam Fleming. It says central banks poised for rate cuts in 2024. Investors and economists predict. And we've seen as well the bond market's predicting it. Yields have dropped massively. We're seeing the dollar melt down versus the Swiss franc. And why am I mentioning the Swiss franc? Well, because I think the Swiss franc is the top fiat currency. It's not the dollar. And the fact that we're seeing this is concerning. Well, not for me, of course, because I don't hold any dollars, I don't think. And but what it means is that, investors see more and more inflation. And at the same time, though, they're declaring victory, that they've conquered inflation and that central banks are going to be able to cut. And I think they will. And it's going to be earlier than they think now. But the other thing that they're going on about, they're trying to detract the attention from there. And by there, I mean the central bankers' ineptitude and the fact that they try to hide it from you, that they're creating the inflation, is that they're saying now that the reason for prices rising as they did in the last 2 years to the highest levels in 40 years is because they couldn't forecast it correctly. It's not because they created trillions and trillions of currency and credit back in 2020, 2021. Oh no, they're not going to mention that. So be aware that this talk about improving inflation forecasting is rubbish. And it's another excuse, another thing to keep you in the game. And by in the game, I mean holding their fiat currencies, holding dollars, euros, Swiss francs, even Swiss francs, pounds, so that they can keep extracting wealth from you, because they can only inflate because the debt is still up to here. And I've shown you many times here, M1 still at massively high levels, way above where we were in 2020. M2 as well, the same. And if you look at the yearly chart since April 2023, M2 has actually gone up. So it's bottomed. So now they're going to start cutting and they're going to start inflating again. And again, hopefully I'll be fortunate enough to be able to have spare fiat currency to stack gold and silver. Am I saying you should do it? No, but I think we could see a massive drop in the fiat currencies versus gold and silver. And that's why I'm still affiliated to these precious metals dealers here, as you can see. And if you're interested in starting, or if you already have gold and silver and you want to add on, yeah, check them out. Anyway, back to the article. Let's quickly go through it. It says leading central banks are expected to begin cutting interest rates over the coming years as falling inflation. While inflation's not falling, the rate of growth of inflation has fallen, but your currency is still being debased. Anyway, as falling inflation fuels predictions among investors and economists that prices are under control. I don't think so. Anyway, after entering 2023 in the midst of aggressive interest rate increases, the Federal Reserve and the ECB and the Bank of England put their tightening programs on hold in the second half of the year. Now, with headline inflation rates retreating in large part, well, these are not inflation rates. These are manipulated statistics called CPI, which the Bank of England, for example, or the Office of National Statistics, was told by the government here to basically change the history of CPI and lower it by about 1%. And that's what they did. And since May 2022, I would say CPI has been underestimated by 1%. And many of you know about shadow stats, how John Williams has been talking about how they keep tinkering with these statistics to make sure that people think that there is no inflation. Anyway, now with headline inflation rates retreating in large parts of the G7 group of industrialized nations, are we really industrialized? I don't think so. And the economy is slowing. The pressure for policymakers to cut borrowing costs is set to gather strength. We expect inflation to fall further than central banks expect, said Neil Shearing, Group Chief Economist at UK-based Capital Economics. The guy who founded Capital Economics, Roger Boodle, wrote a book back in 1996, I think, that inflation was dead. So that's how much they know about inflation, these economists. He noted that growth was weakening just as distortions caused by COVID pandemic and global energy crisis were unwinding. Are they really? Policy is now quite restrictive, meaning central banks can loosen without it necessarily becoming supportive of growth. Think of this as pressing less hard on the brake and pushing on the accelerator. He says, can loosen without necessarily becoming supportive of growth. Why wouldn't you want growth? Well, because these Keynesian economists think that growth creates inflation. It's all warped. Investors are betting the Fed will cut for the first time in March. So actually, I think it was May until a few weeks ago, with 5 quarter-point cuts to follow during the year, according to market pricing. The ECB and the BOE are also expected to lower rates 6 times in 2024, with the former starting in March or April and the latter in May. I'm going to stop right here and I'm going to show you a historical chart of the Fed funds rate. And you tell me if this is going to be higher for longer, and the fact that they're going to start cutting in 3 months. So, I mean, if you go back to, let's say, 1995 to basically 2001, rates are quite high. They were above 5% most of the time there for about 6 years. So I would say keeping rates above 5% for 6 years, for 10 years, that would be higher for longer, especially when you see here that they kept rates at virtually zero, from 2009 up until 2020. Yeah, they tried to raise it in the late teens here, but they had to drop back. So to say that it's going to be higher for longer and they're going to cut again in March or April or June or maybe even February, I think is just another failure by the central bankers, by economists. And I think investors are going to regret not having exposure to hard assets. And I'm not saying people should move all their savings or investments into hard assets, but I think a small exposure will go very far, especially under these circumstances. I predict that by the end of this year, yeah, predictions, I know, that they will have lost control of prices again. Not inflation, because they already lost control of inflation. They haven't brought it down, as you can see by M1 and M2. Unfortunately, the Fed stopped publishing M3 over a decade ago. I wonder why. Well, because they don't want people to see the real inflation. So yeah, that's my first message here for 2024. Don't be fooled by this talk that they've tamed inflation, that they can cut rates without any consequence, because they can't, in my opinion. And unfortunately, not unfortunately, but everything's closed today, so the markets are not open. Tomorrow we'll update on the markets. That will be the first trading day of the year, I guess. And Rudy's here. We've had our walk already this morning, and he's doing well. And so with that, I'm going to wish you all a very good start to the new year and a very good day. Take care. Bye.